Imagine a serene mountain lake. The water is still, reflecting the snow-capped peaks above. A gentle breeze rustles through the trees, whispering tales of tranquility. This peaceful scene, however, belies the potential for sudden storms. The placid surface can quickly transform into a raging torrent, driven by unseen forces deep within. The world of finance often mirrors this natural phenomenon. Periods of apparent calm and prosperity can mask underlying vulnerabilities. These weaknesses, like tectonic plates shifting beneath the Earth's surface, can build up pressure. Eventually, they erupt, creating financial earthquakes that shake the foundations of the global economy. Throughout history, financial bubbles have followed this pattern. They begin with irrational exuberance, a collective euphoria that drives asset prices to unsustainable heights. This excitement is often fueled by speculation, easy credit, and the belief that this time is different. However, just as the calm of the mountain lake can be shattered, so too can the illusion of endless prosperity. When reality sets in, the bubble bursts. Prices plummet, investors panic, and the consequences reverberate throughout the financial system. The following sections will explore 4 such instances: the Great Crash of 1929, the Japanese asset price bubble of 1989 to 90, the Dotcom Mania of 1999 to 2000, and the housing bubble of 2007 to 2008. The Roaring Twenties were a time of unprecedented economic growth and social change in the United States. Jazz music filled the airwaves, flapper dresses redefined fashion, and a booming stock market promised riches to all. This era of prosperity, however, masked a dangerous trend: rampant speculation. Fueled by easy credit and margin buying, investors poured their savings into the stock market. They believed that the good times would last forever. Share prices soared to dizzying heights, detached from any reasonable assessment of underlying value. This speculative frenzy reached its peak in the summer of 1929. Then the bubble burst. On Black Thursday, October 24, 1929, the stock market crashed. Panic selling gripped investors, sending share prices into freefall. The crash marked the beginning of the Great Depression, the worst economic downturn in modern history. Banks failed, businesses collapsed, and unemployment soared. The effects were felt worldwide, highlighting the interconnected nature of the global economy. The 1980s witnessed the meteoric rise of the Japanese economy. Fueled by technological innovation and a strong export sector, Japan emerged as a global economic powerhouse. This rapid growth, however, led to asset price inflation. Real estate and stock prices soared to unprecedented levels, driven by speculation and loose monetary policy. By the late 1980s, the Japanese stock market had reached astronomical heights. The Nikkei 225 index, a key measure of the Japanese stock market, peaked at over 38,900 points in December 1989. Real estate prices in Tokyo were equally inflated, with a single square foot of land in the Ginza district reportedly worth more than $1 million. However, this unsustainable boom came to an abrupt end in 1990. The Bank of Japan raised interest rates in an attempt to curb speculation. This triggered a stock market crash and a collapse in real estate prices. The Japanese economy entered a prolonged period of stagnation known as the Lost Decade. The effects of the bubble's burst were long-lasting, highlighting the dangers of unchecked asset price inflation. The late 1990s witnessed the rise of the internet and the dawn of the digital age. The potential of this new technology seemed limitless, and investors were eager to cash in. This enthusiasm fueled the dot-com bubble, a period of intense speculation in internet-related companies. Fueled by venture capital and initial public offerings, dot-com companies with little or no profits saw their valuations soar. Investors caught up in the hype ignored traditional metrics of value. They focused instead on website traffic and future growth potential. However, the bubble burst in early 2000. As investors realized that many dot-com companies lacked viable business models, the market crashed. The Nasdaq Composite Index, heavily weighted towards technology stocks, lost over 75% of its value from its peak in March 2000. The dot-com bust served as a stark reminder that even in the face of technological innovation, fundamental economic principles still apply. The early 2000s witnessed a boom in the US housing market. Low interest rates and lax lending standards made it easier for people to obtain mortgages. This led to a surge in demand for homes, pushing prices higher. Financial institutions, eager to profit from this boom, created complex financial instruments known as mortgage-backed securities. These securities bundled together thousands of individual mortgages, including many subprime mortgages made to borrowers with poor credit histories. As housing prices continued to rise, these mortgage-backed securities were seen as safe investments. However, this assumption proved disastrous when the housing bubble burst in 2007. As interest rates rose and the economy slowed, defaults on subprime mortgages surged. This triggered a chain reaction throughout the financial system, leading to the collapse of major financial institutions and a global financial crisis. The financial bubbles of the past serve as cautionary tales. They remind us that periods of irrational exuberance and speculative excess are not sustainable. They also highlight the importance of sound economic fundamentals, prudent risk management, and regulatory oversight. As we look at the financial landscape today, we see signs of both optimism and concern. Technological innovation, globalization, and low interest rates have fueled economic growth and rising asset prices. However, we also see high levels of debt, geopolitical uncertainty, and potential asset bubbles in areas like technology and real estate. The question remains, are we on the cusp of another major financial bubble? While no one can predict the future with certainty, history teaches us that periods of exuberance often precede periods of significant market corrections. It is essential to be aware of the risks and to approach investment decisions with a healthy dose of skepticism. Only then can we hope to avoid repeating the mistakes of the past and ensure a more stable and sustainable financial future.